Ladies and gentlemen, good day and welcome to the TEAMLEASE Services Limited Q3 FY21 earnings conference call hosted by ICICI Securities Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Sudhir Guntupalli from ICICI Securities Limited. Thank you, and over to you, sir.
Thanks, Faizan. Good evening, ladies and gentlemen. Thanks for joining us today, and sincere apologies for the slight delay in opening the call. On behalf of ICICI Securities, I would like to thank the management of TEAMLEASE Services for giving us the opportunity to host this result conference call. We have with us Mr. Ashok Reddy, Managing Director and CEO of the company, Mr. Ravi Vishwanath, CFO of the company, Ms. Rituparna Chakraborty, Executive Vice President, General Staffing, Mr. Sunil Chammankotil, Senior Vice President, Specialized Staffing, and Ms. Ramani Datti, Finance Controller on the call. We'll open up the floor for brief opening remarks from the management team and subsequently open the floor for questions. Thanks, and once again, thank you all for joining us today. Over to you, Ashok.
Thank you very much. Thank you, and welcome all to the call. I think we have started to see demand coming back, and I think our apprenticeship program, the trainee program that has taken the biggest hit in Q1, has been a rebound, and we've recovered the numbers back to and crossed the pre-March levels that we entered the year with. And I think even on the staffing side, we have started to see growth in numbers and demand coming in from customers' end. I think overall we have managed to drive the aspect of productivity and cost management through this quarter also. So we have had a marginal decline in our core employee headcount, while we've seen an overall 16,000 additions to our deployed resources. So staffing has grown by about 7,000 associates, and NetApp has grown by about 9,000 trainees, overall 16,000 growth for the quarter. The productivity as an aspect of an FTE ratio has also improved to 334. And I think during this period, we have managed to sustain the level of PAPM and the funded percentage broadly. I think the big positive, which Ritu will cover on, has been the big jump that we have had in hiring for our customers and the various strategies that we have been working on over the period, playing out for the aspect of hiring for the open positions and delivery thereon, complementing and supporting the client's desire to ramp up. Overall, on a quarter-on-quarter basis, we have had a revenue growth of 13%, EBITDA growth of 8%, and a PBT growth of 17%. And even for the 9 months, we've had a PBT growth of about 4%. The PBT margin has also improved to about 1.8% for the 9 months. We've also seen an EPS growth of about 24% from 10.9 to 13.5 as a quarter-on-quarter aspect. I think overall the trajectory with the open positions and demand that we are seeing from customers is quite healthy, and we believe that we should be able to get back on an associate headcount and a revenue run rate to the pre-COVID levels soon. And obviously the aspect of the cost rationalization and productivity aspect will help in the aspect of margin improvement or going back on the margins at a PBT level as we go forward. With that, I would ask Ritu to give a commentary on the staffing side.
Good afternoon, everyone. been overall for us. We managed to consistently grow our associate base over previous quarter, especially since September when we noticed a net jump. We continue to improve our productivity and also profit for associates. After the last 2 quarters spike in funding, we were able to plow back that exposure to a reasonable level, and I think we do hope we'll be able to sustain it. PAPM remained flat, and while all past discounts have more or less been reversed, we are seeing more long-term downward rationalization expectations coming in from some specific sectors. However, we are quite confident about maintaining our profit per associate, if not improve, on the back of consistent investments in digitalization of our processes, and various innovations to kind of kick up the operating leverage. Our biggest improvement and turnaround, of course, has been in hiring. I think we've tripled the count of TEAMLEASE hired temps. This is, for the last quarter, we rolled out almost 9,000 offer letters. And that is also a 37% jump over Q4 of the last financial year. We've improved our average for-client conversion rate, which is about 60% currently. That's quite an improvement over a pre-COVID level. Incidentally, with some of our clients, we've managed to deliver up to 100% of their requirements. We've also successfully contributed to almost 21% of our additions through hiring, as against 15% last quarter. And I think one interesting thing which obviously helps us build confidence amongst our customers as well as within ourselves is the fact that we've managed to successfully deliver some profiles which emerged as an opening for the first time in terms of a formal temp job. And I think that's been an interesting experience for us. Just to give you some sense of the future outlook and how we have been seeing the market, daily intent to hire is improving and vaccines have added to the optimism. However, caution isn't being ruled out. Metro and Tier 1 cities are likely to gain from the optimism with increased hiring in sales, marketing, technology, and blue-collar roles. Healthcare and essential sectors such as FMCG and retail, as well as technology-intensive sectors like education, e-commerce, are expected to scale up hiring. Manufacturing sectors actually leading the positive hiring outlook, while services sectors are largely cautious. However, the exceptions in services would be telecom, essential retail, IT, and e-commerce. I think within manufacturing, FMCG and pharma companies are largely focused on hiring around the large cities. FMCG, engineering, chemicals, power and utilities are hiring at the lower levels and it's a little more spread out. From a sectoral change, I think some of the government announced initiatives, CLI, PMJY, easing of the FDI have definitely given some sectors, specifically pharma, education, and manufacturing. So our sense is that the sectors which essentially have been contributing since the first unlock, we are seeing a magnified interest in hiring coming in from those sectors. And few of the laggards which were struggling a little bit, for example, BFSI, have also now started to kind of open up. A brief on some of the updates on what's going on the labor reform side. I think government is acting on waterfooting to close out the deliberations around the rulemaking for the whole labor code. Considerable pushback has been received from the trade unions on the 4 codes, especially OSH and the Social Security Code. From the corporate side, there has been considerable pushback on the wage code. And I think all of them are being factored in. I think from a staffing perspective, we've had some positive movement and good progress around the rulemaking process around national licensing. Our belief is that by 1st April, most of the labor codes with the rules will become implementable. And by mid-Feb, we should be able to see the final final draft. I think in closing, our focus for general staffing into the future shall be on organic associate growth, aggressive hiring aided by non-recruiter-led channels, improving operating leverage, and sustaining capital efficiency. Thank you very much.
Sunil will give an update on the specialized staffing business.
Thanks, Ashok and Ritu. Good afternoon, everyone. Specialized staffing business this quarter had a nominal revenue growth of around 2%. Headcount remained flat due to some drop in telecom staffing business. The PPT grew marginally from 8.3% to 8.5%. However, there is a sequential growth quarter on quarter on the PPT. Although this quarter our recruitment has doubled from last quarter in terms of the gross addition, still the net additions did not happen as expected because we had a huge attrition. This is also a good indication that the market is opening up and there are new opportunities available for the resources. So we are just able to get as many on board as possible against the possible attritions. The good news is that the replacement positions what we have done is mostly in high margin positions like data sciences, ML, AI, US, mobile application development, video production, and so on, which actually in a way gives us a better overall margin. Along with this, we also had the operational efficiency going on from the quarter one, and which has resulted in a better PBT for us. The change in requirements, we feel that we continue in the coming quarters because we are seeing there is a huge change in the kind of positions which customers are requesting us because of the adoption of digital technologies across the industry sectors following the business disruptions caused by the pandemic. On the sales front, we have been very focused on our sales approach because we wanted to expand our client base. This year, it was one of the major focus along with operational efficiency, and we were able to continue this effort. We added 17 new logos in Q3, which takes us more than 50 plus new logos for this year. Majority of them are long-term and large customers which are going to help us propel our growth towards our goal. To sum it up, the strong delivery, focused sales approach, and improvement in operational efficiency has ensured a consistent and good results in this quarter, and I'm confident that this will continue going further. Thanks. That's it from my side.
Thanks, Sunil. Ravi will give an update on the finance front, and then we can open up for questions.
Good evening, everybody. A quick update on some of the finance matters. We continue to focus on costs. While most of the cost play has been done, we expect some of the costs that we have not incurred in the past 3 quarters to slowly start creeping up. So it will not be to the same levels as what it was in Q4 or Q3 of last year. Some costs, like we said, will come back as offices reopen, and that's bound to happen, and we are kind of prepared for it and kind of factors.
Ladies and gentlemen, the line for the management is disconnected. Please hold while we reconnect them. Thank you. Ladies and gentlemen, thank you for patiently waiting. The line for the management is reconnected. Thank you, and over to you, sir.
So, Sudhir, we are open for questions.
Hello?
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Reminder to the participants, anyone who wishes to ask a question may press star and 1 at this time. The first question is from the line of Sudhir Guntupalli from ICICI Securities. Please go ahead.
Yeah, sure. Ravi, I think you were talking something about, you're saying something about margin, and looks like the investor presentation had some typos in terms of margin. So any clarification from your side on this aspect?
Yes, we have updated. Yes, there was a typo. The error is regretted. The updated presentation is being uploaded now.
Uploaded, give them.
So the consolidated numbers have been mentioned as standalone only, so that's the error. So you should read standalone numbers as consolidated and consolidated standalone. The explication is already filed and it's reflecting in the postal now.
Effectively, EPS has been a growth quarter on quarter.
Sure, Ravi. Thanks for the clarification. With that said, in terms of margins, we had undertaken some cost rationalization initiatives earlier, and we were talking about reaching FY19 level EBIT margins by FY21. But if you look at this quarter numbers, two questions. One is it looks a tad lower than what we were expecting, let's say 3-4 months back. And given this numbers in this quarter, are you still confident? The second part of the question is, are you still confident that we'll reach FY19 level EBIT margins for the full year?
I think we should be able to get to FY19 margins by the end of Q4. We are reasonably confident, and we do believe that that we have done all the necessary things for us to get to those margin levels.
We already at 2% on the EBIT margin, and I think the aspect of sustaining that as going forward will happen. And at a PBT margin level, at a 9-month level, we've improved from 1.6% last year to 1.8% this year. So I think the overall trajectory of margin improvement, both at an EBIT and PBT level, is in line with the playout for the year.
Sure, Ashok. Thanks for that. And any moving parts that you want to add as to which would have impacted margins in this quarter versus the previous quarter, be it pricing or what exactly would have impacted?
So we pass through. Yeah, so I think we have a provision that we have made in the learning services business for a part delayed payment from a government. While we've received 50% of the payment, some of it was delayed. So just as abundant precaution, we have made a provision for that amount, which has impacted the profits for the current quarter. But we believe that amount should be collected in the Q4. And from that perspective, would have a right back element in there. Other than that, we've also had some element of continuance of the term business provisions that we have decided to exit on for the earlier receivables that clients are delaying at separation. So other than these two, which will not be a running account as we go forward, other businesses have all standalone improved on their now.
Sure, Ashok, that's very helpful. And my next question is on the sourcing aspect. So sourcing is one of the key areas of micro level improvement for us for some time. And as you mentioned, the non-recruiter channel seems to be picking up over the previous couple of quarters. So how does our unit economics in sourcing look like right now? And in the steady state, what would be our aspiration in terms of the share of general staffing associates who would be sourced by TeamLease and not by the non-recruiter channels?
So I think non-recruiter channels are also managed by us, but effectively what happens is that we are not increasing resources at our end, nor are we having a fixed cost play from our end. So part of the non-recruiter channels are free of cost, and some of them have a variable cost attached to the element of delivery that happens. So effectively, I think what it enables us to do is have a broader footprint at a lower cost and effectively ensure that we are delivering to the client open positions across locations. These channels are managed through technology and our team at the back end. And from that perspective, I think the key focus for us is to ensure that we have a larger number of clients that we are delivering to and a larger percentage of their open positions that we are delivering to on a consistent basis. And I think clearly we've had that trajectory of improvement on number of clients and the percentage of positions that we've been able to deliver to, which is kind of complementing the element of the numbers that come from customers and also offsetting the attrition that is happening. So effectively over the last 3 months of the quarter, we've had consistent net growth in staff.
From a unit economics perspective, the cost per hire tended to be in the region of between 2,500 to 3,000 rupees per hire. I don't think it will come down significantly, but our target is to take it down to anywhere between 750 to 1,000 rupees per hire.
Sure, Ravi. And will the clients be willing to compensate us for this, or this is kind of going through our pockets?
So it's a function of the client agreement. There are some clients with whom we have an element of a sourcing fee for the placements that we do. Some of it is factored into the existing pricing.
Sure, Ashok. One last question to Ritu, if I may. So Ritu, I just want to understand in detail about how the overtime related labor laws are changing and how that would potentially impact the volume and numbers for us going forward. So will the allowance of higher number of working hours essentially deflate our headcount numbers, and how would the payment dynamics, how would the wage dynamics work in that situation?
So I think first and foremost, there has been considerable deliberations and pushback as was expected from corporate on the timing of some of the changes that have been recommended by the government. Given that industry is already down and out and recovering, whether they will be able to afford some of those things. I think we must admit that while on paper, some of them like increase in gratuity provisions, the fact that overtime as a concept has been standardized to twice the wages. I think all of that has happened, the side-by-side government is also looking at opening up alternative avenues for organizations to manage their employee supplementation rates. Also from an EPFO perspective, it is already a narrative in terms of whether the contribution can be brought down from the current level of 12%. So I don't think, while the rules will get notified we expect it somewhere around the mid of Feb. But implementation horizon will take time, so it's not going to happen before 1st of April. So I think organizations do have time to kind of look at the alternatives, and I believe that once the revenue kick up, it is already clear. Some of the apprehensions and worries that are being tabled shall be addressed. I personally feel that there are greater upsides which organizations will see by reduction of their cost of compliance. And those reductions and improvements, for example, on account of rationalization, if I were to take just the OSH board, as against 123 compliances, they'll have to end up doing not more than 6. There are cost benefits which are coming into play, and some of the initial reactions of increase in wage costs and wage bills will in the long run get negated, and I don't see any negative or adverse impact on account of that on staffing from where I stand.
Thanks guys, and all the best for the future.
Thank you.
Thank you. The next question is from the line of Garima Mishra from Kotak Securities. Please go ahead.
Yeah, hi. Thanks so much for this opportunity. I had a question first for Ritu. Amongst your interactions with corporates, do you think that corporates in general are getting more inclined towards general staffing post-pandemic, as this can be something that can help them save costs in general over the future?
Yes, there is definitely an improvement in mood in organizations to discuss and engage with us as this being a viable option for them to manage their workforce. I think organizations are more inclined towards considering it on account of the flexibility it offers them, given that they are right now quite affected by the impact and repercussions that the pandemic had on them. I think that is the primary factor. I don't think the staffing options provides them an ability to have high cost arbitrage on account of the wages, because the government is very clear even in the labor codes that there cannot be much differentiation based on job roles. But I think there are implicit advantages of working with staffing organizations on account of flexibility, on account of scale, on account of hiring, for example, their ability to ramp up as well as ramp down, I guess. And also having a partner, a large professional organization who understand the law of the land well and would be able to guide them in the right fashion to be able to manage the needs of their business and yet keep them compliant. I think from that perspective, Garima, there is definitely a growing interest in staffing as an option for meeting their workforce requirements. And I think clearly there is a shift from moving away from the traditional approach of having a large core of permanent employees. Organizations are looking at alternative options of managing their headcount based on the ups and downs of the business, and staffing is probably one of the most win-win bets for them at this point in time.
So, are you seeing, in terms of TeamLease's own pipeline, are you already seeing some build-up on account of this shift happening? Or currently the increment to your pipeline is purely because of, some economic activity coming back? What I'm trying to ask is, I guess, has there been some structural improvement already that you are seeing, or is it a little too early for that to happen?
Yeah, so I think, Garima, like I said, at the moment we are in engagement stage with most of these organizations. So even they are looking at it as a long-term play, and they are non-committal at this point of time. That's why I keep mentioning that we notice optimism, but we also notice cautious optimism. Net of it, we've seen data points which clearly suggest that while October and November were good months, things started becoming subdued in December. So we actually have to see how things pan out over this quarter for even organizations to frame their mind in terms of whether at what point they are willing to commit. So I would categorize all of this as discussions and engagement rather than an active pipeline at this stage. We do have pipeline for this quarter, but I wouldn't necessarily attribute it to this new discussions that we just mentioned.
Also, I think very much just to add to that, it's difficult for us to distinguish between the growth or demand coming in because of economic factors and because of structural change. I think overall, the willingness to dialogue, like Ritu said, is a lot more, even from existing and from potential new clients. And, frankly, as a waiter in the restaurant, we are fine for it to be structural and or economic to be driving up the numbers as we go forward. But clearly, our belief is that these kind of shocks to the economy tend to make corporates more open to dialogue, given the benefits that the staffing element and outsourcing element can bring to the team.
Understood. And my last question, could you help us with some update on what's the latest at School Guru and IMSI?
School Guru has turned profitable for quarter 3. We've effectively looked at School Guru having 3 streams of revenue. One is the university revenue, one is the corporate revenue, and one is the element of student revenue. Obviously, there are no physical training going on at this point, very few. Most of it is virtual instructor-led training, leveraging the Learning Go platform that School Guru has. So in terms of number of students, number of corporates, and number of universities, there is a greater acceptance and buy-in, and to some extent, the seasonality of that billing has kicked in Q3. The business has turned profitable and has a healthy pipeline for billing in Q4 also. I think the technology platform investments have happened, are further improvements as we go forward in line with feedback that we receive from the customers and from the users. And that is a path that we will continue on. But I think effectively we do see the aspect of continuous growth in revenues and profit play as we go forward from the School Guru perspective. And I think the team has also fallen into place comprehensively and will sustain itself to the future. From an IMSI perspective, I think that business also continues to be profitable. There's still, like we had mentioned, some element of the focus on scale that we will drive on as we go forward. But I think the aspect of productivity, the team being in place, the aspect of focusing on new sales as Sunil had communicated earlier will be focused for us. Effectively at a PBT percentage level for the quarter, the School Guru is at about 24% margin and IMSI is at a 14% margin.
Understood, Ashok. Thanks so much for that.
Thank you. The next question is from the line of Susmit Patodia from Motilal Oswal AMC. Please go ahead.
Hi, good evening everyone. Wishing you a very happy new year. A few questions. Firstly, on the reported EBITDA margin for general staffing, that's just quarter on quarter.
This is the operator. So the audio is breaking from your line, so please check.
Okay, I'm breaking now. Okay.
Just the same.
Okay, let me try. Okay, if you can explain the general staffing Q-on-Q bit as reported in the presentation, because I'm asking this in the context that Ritu did mention of rolling back of discount.
And EBITDA, not EBIT, because EBIT has a other income angle.
You are asking for general staffing EBITDA, QOQ movement?
Yes.
Yes.
Down.
Yeah. So during the quarter, we've had some billings on which, being a festival quarter, we've had some billings, some gross billings on which we wouldn't have had a markup charge to some of our customers, which would then result in our percentage margins actually dropping. That is what has contributed to the drop in margins from the 2.1 to 2% between Q2 to Q1, Q2 to Q3.
I'm trying. Quarter. It adds up. 75% of our assets are around.
Sorry to interrupt you, ma'am. The audio is breaking from your line.
It's actually not from us. It's coming from somewhere else. We are getting the disturbance.
Yeah, it's clear now. Correct. Hello?
Yeah, sorry, you were saying something.
Yes.
So you can just mute your line while Ramli. I think there's a disturbance coming in from your line.
So in absolute rupee terms, EBITDA for staffing has gone up by about 1 crore between Q2 and Q3. But however, since 75% of our associates are on fixed markup model, and during Q3, during the festive season, we process additional billing, but the markup being fixed, so on percentage basis, there will be a slight dip in the EBITDA margin percentage. So 2.1 has come down to 2% in Q3. But however, by end of the year, on a full year basis, we are confident that we will get to last year's EBITDA margin.
Got it. Okay. And the second question was on specialized staffing. As the environment picks up, I'm guessing the portability in specialized staffing is easier than general staffing. Because of that, we have higher attrition. So does this make it a little anti-scale?
Sunil, do you want to address this question?
So this is normally the model which how we work in specialized staffing. So since the markets have just opened up, there are a lot of employees who have been waiting for making the movements. That's the reason the Q3 we got that hit. Normally, the number of attritions are far lesser than the onboardings what we do. So I think in the coming quarter this will be balanced, and we will see more additions happening than the attrition. I don't think the kind of attrition what we witnessed in Q3 will repeat in Q4, because that's just an opening kind of a syndrome of the market, and which is a very good sign for us, because it also tells us that there are a lot of positions available across, which is also visible across the job sites. So we have ramped up our delivery teams, and we are fully prepared to overcome this short-term challenge. But on a long term, I don't think that should have any effect on our overall growth trajectory.
My last question to Ritu. There is this interpretation in the new labor code that PF and gratuity may have to be calculated on total CTC and not on basic. And this will lead to a lower salary in hand than on paper. So is this an issue that you see, and this could actually be anti-formalization?
Okay, so I think I know this particular narrative has been overplayed and, if I may say, misinterpreted as well. In February of last year, the Supreme Court judgment clearly spelled out what constitutes the PF wages, which essentially incorporates everything that is part of an individual's gross wages, excluding HRA from the calculation. So if organizations have already started to follow that norm, I don't see too much of a issue honestly on this front. What essentially has happened is that the labor code has mandated that the allowances cannot be more than 50%, which in effect has ensured that your basic plus DA will definitely go up. Because gratuity calculation is not on CTC, it is on your basic plus DA, there will be an increase in the provision that companies have to make on account of this. So that's essentially what has happened. And I guess that we have, what has ended up happening is organizations have mixed up all of them, and that's why the narrative sounds the way it does. Does it increase the cost of organization, cost to company of organizations? Yes. Does it increase the net take home? It actually reduces. However, employees definitely stand to benefit, though it's a kind of a hit for organizations who are not complying by the rules as mandated by the Supreme Court, and those whose wage structures were highly allowance dependent and to keep PS low in the erstwhile structure. Does that answer your question?
Yeah, so thanks for explaining this, but is this a little anti-formalization, like something what happened with the 6-month maternity leave? You have unintended consequences.
It is a short-term impact, of course, but the thing is, government is also side by side opening up avenues to reduce, for example, the PS contribution from the current 12%. So I think ESIC has already reduced. So essentially, it's going to be a dance between what you give up and what you get.
Okay. Thank you very much, and all the best. Thank you.
Thank you. The next question is from the line of Abhijit Akella from IIFL. Please go ahead.
Good afternoon. Thank you so much for taking my questions. So just a clarification on the margins this quarter. There seems to have been a fairly sharp jump in other expenses sequentially on the P&L from about 21, 22 crores to about 26. And then similarly, when we look at the segment reporting, if we calculate the unallocated expense, that also seems to have increased from about 3 odd crores to about 6 odd crores. So, is there any element of like just expenses coming back now that business is recovering, or any one-off items within that?
Hi, Abhijit. Our operating expenses has a combination of the overheads, the general overheads, as well as business expenses of other HR services. So if you notice, other HR services revenue has gone up by almost 38% sequentially, which is almost a 4 crore growth. So that has a corresponding increase in their operating expenses by 3 crores. So the balance 40-50 lakh overheads have gone up with the offices opening up and capacity being operated at a 50% capacity.
Okay. Then thanks, Ramani. Just to clarify, when I look at the overall segment level EBITDA, it seems like the unallocated overhead portion has increased quarter on quarter. So is this a good run rate we should work with going forward? 6 odd crores per quarter.
Yes. So around 5 to 6 odd crore will continue as a run rate.
Okay, got it. And just one last thing from my side. In terms of the growth in revenues this quarter, sequentially, it's been almost, I think, 13-14%, which is significantly faster than the growth in headcount we've seen. So, and I'm just trying to reconcile that with the fact that you mentioned PAPMs are actually flat. So, was there some element of seasonal hiring and then, layoffs again, or what exactly resulted in this?
It's not seasonal hiring, Abhijit. It is seasonal billing. So there is an incremental billing that happens during the festive season. So which has led to almost a 13 to 14% growth in staffing sequentially, whereas headcount growth is only 5%.
Okay, got it. Thank you so much. Wish you all the best.
Thank you. The next question is from the line of Jonas Bhutta from Phillip Capital. Please go ahead.
Good afternoon, and thank you for taking my questions. Two questions. Firstly, sir, pre-COVID we had this narrative of the specialized staffing share of revenue sort of going up, and that being one of the key levers to our margin trajectory towards 3%. However, post-COVID, the narrative has been more on the cost front on the GS side. Wanted to get your views on the specialized staffing, because I see that both the IT service and the IT infra businesses are already at 14% EBITDA margin. So do we see any further scope of margin improvement in these two business verticals? And how should we look at percentage increase or proportion increase in special staffing as a percentage of total sales going up from the current 8-9%? Should it sort of trend towards 16% in next 2 years, or will it hover around the 10% mark? That's my first question.
So I think the aspect of specialized staffing being a margin contributor to the business will continue to play out. And I think for the year, we are focused on, as we had said at the start of the year, that we work on consolidating the various units of the specialized staffing and bring about rationalization around the aspects of the team, the productivity, and the working. And I think that is kind of played out. We had also said that certain low margin volume businesses we would exit in the specialized staffing business, and that has also been playing out. So while at a net headcount growth level we've been kind of flattish, I think clear margin improvement and profit improvement has been there. So even if you look at the 9-month like-to-like comparison, there is about a 14.8 that has gone to 24.6. And I think that trajectory of profit improvement has been positive. I think overall moving the PBT percentage to about 9 to 10% and sustaining it there will be the primary focus, and our belief is that we should be able to do that as a mix of the client portfolio, the mandates, the margin structures, and the cost structures that we have at our end. Obviously, as Sunil said, the focus now has been in adding on new customers who have potential to grow with us. And effectively, now that we've signed a number of accounts and we continue to have the focus to sign more accounts, it will be on ramping up the numbers further. So I think overall, even at the back end, the hiring team size play and the hiring team productivity is the key focus area that we are driving on. So I think while we don't have too much of a control on attrition, what we are focusing on is the gross addition, and that comes by effectively having a higher productivity that ensures that we are putting more into the bucket of joining, so that even if there's attrition, the net growth becomes a corollary thereafter. So will be key. The cost rationalization, productivity aspect, there's still some element of play on that front, and driving the PBT to a 9-10% is going to be the key focus for us.
So just to add on that, so the 400 average, so 100 crore per quarter kind of run rate, do you see that trending closer to 500 crore in 2 years' time based on what, the new account additions or the synchronization of the sales and everything?
I would love it if Sunil were to do the 500 next year. So I think the market is opening up. Clearly, new accounts take a little more time to effectively ramp up in numbers. So it takes between 12 to 18 months to ramp up new accounts. But, the focus will also be on driving numbers up with existing accounts. So yes, we will exit with about 400 odd crores this year. I mean, at least a 20-25% growth should get us to a 500 crores, and that's what we'll be targeting as we go forward.
Thank you. This is the operator. Sorry to interrupt you, Mr. Bhutta. May we request that you return to the question queue for follow-up questions? Thank you. The next question is from the line of Amar More from Alpha Accurate Advisors. Please go ahead.
Yeah, hi, sir. Thanks a lot for the opportunity. And primarily from the productivity side. So I believe in this quarter we had seen around about 11% increase in the specialized staffing productivity. So do we see this kind of the productivity to continue from here on? So I'll tell you what I'm doing is specialized staffing revenue divided by number of employees, total IT staffing plus telecom staffing plus IT infra.
Yes, Amar. So we expect the productivity in specialized staffing continue to improve because we are not adding cost linear to the growth in revenue. Mm-hmm. So this will continue, but may not be at this rate because this year we have done substantial rationalization in terms of cost and headcount. Not at this rate of the current year's rate, but definitely the productivity enhancement will continue.
So just to understand, if I see probably by the end of the year, your yearly productivity would be around about 54,000 approx. So is it fair to assume that at least next year you will at least maintain that?
Sorry, what is the 54,000 that you are looking for?
So basically what I'm doing here is that the annualized revenue of specialized staffing divided by the total employee base.
Are you taking total employee base of specialized staffing? Or?
Yeah, specialized staffing.
The associate base. You're taking the placed associate base, right? Not the core employee.
No, I'm taking the whole associate base. IT staffing total.
That doesn't reflect activity in any manner.
Okay.
Yeah.
It has to be core employees.
Okay. I mean, a division by core employees will reflect revenue per employee.
Correct.
Division by the associate count will give actually broadly the cost, the bill rate per employee.
Yeah. So basically, that is what probably my question is. The bill rate per employee, which has gone up this particular quarter, do we at least can maintain that kind of bill rate going forward?
So we will largely sustain the bill rate per employee because as has been stated before, the bill rate is a combination of the 3-4 verticals that are there in the specialized staffing business, and we are focusing on getting higher rate card mandates from customers and taking it off. However, specific to telecom and network security, the bill rates are lower. So should the volume go up substantially in those two lines, it could impact the bill rate per associate. But I think for us, the focus is really on the gross margin and the aspect of the employee productivity that leads to profits.
Thank you. This is the operator, Mr. More. We request that you return to the follow-up questions. Ladies and gentlemen, we'll take one last question from the line of Edelweiss Financial Services. Please go ahead.
Yeah, everyone. My question was more on the competitive landscape. When COVID came in the picture, there were these talks about how small staffing companies would actually suffer because of that. Now, 8 or 9 months down the line, what is your sense on the competitive landscape? Probably barring the top 3 or 4 companies, has the landscape really deteriorated with the smaller companies, or given the recovery we have seen in the last quarter or so, even they have come back to normal? What's your sense of that?
Yeah, so I think if I were to give you, of course, we would not be able to comment on quantification from what's happening in the outside market, but yes, from the client acquisition that we have noticed happening, the consolidation that has happened in some of our existing mandates suggests that it is some movement from the smaller organizations to professional, the organized companies like ours. And thing is, I mean, at this point of time we see, but we have to see how it goes in the near run. Our estimate is that we would definitely, even if it's not a rapid or a massive shift, this chipping in of the smaller companies moving away from the smaller entities to the to companies like ours will happen. It would not be a switching on of a. I mean, it wouldn't be a eureka moment, but it will be a gradual shift that we anticipate.
Also, just to add, I think the overall landscape of large players and some fragmentation of the market will never disappear. But clearly, some of our growth in numbers have happened as a transition from some of the smaller players is an element of a consolidation discussion that is happening with some of the other customers. So like I had said earlier to Garima's question, that we will not be able to unpack what is structural growth and what is effectively economic activity growth. To some extent, it will be difficult to quantify the transition growth also in this situation. But I think by experience on the field, we do see some element of a consolidation, but that does not mean that the small players will disappear.
And look, again here, one of the asks that we've been having for a long time is for this invoice matching or the e-invoicing thing to go live. October was when it was made mandatory for companies with turnover over 500 crores. January was when it has been made mandatory for companies with over 100 crores. And April is going to be made mandatory for everybody. That, coupled with the labor codes going live, will probably aid a lot more formalization than what we've seen before. I mean, like Ashok said, some of the smaller players will probably, turn a new leaf and become formal. Because informal guys could probably turn formal. But these are things which need to be done for the formalization story to continue.
Thank you. Ladies and gentlemen, due to time constraint, we will take that as a last question. I would now like to hand the conference over to the management for closing comments.
Thank you. So I think overall, like Ritu was mentioning and we have been stating, there is cautious optimism and demand coming back into the market. Overall, I think from a headcount and revenue run rate, we are going to be soon getting back to the pre-COVID level. Our free cash flow reserves have improved substantially as a function of operating cash flow and TDS refunds that we have got. We will be continuing to focus on driving margin expansion through operating leverage and the turnaround of the HR services that we have been seeing. The glide path for firm business is more or less completed. The institutional business will reinitiate activity once classroom training starts. But clearly, we are not taking any more new mandates, and we will be exiting that to focus on corporate training activity. I think the future growth and volume increases, we will work to support through our core employee headcount. We don't look at any major increase in headcount happening at our end. And I think the sustaining of that growth through the current employee count will aid productivity and will support the element of margin improvement. We are quite bullish as we go forward in the current element of the market feedback. We do look to the demand sustaining and we driving up the numbers based on that as we go forward. With that, thank you very much.
Thank you.
Thank you. Ladies and gentlemen, on behalf of ICICI Securities Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.